Hello everyone, welcome back to our channel. Today's topic is about how to maximize profits in investing, passive funds versus active funds. As you know, investing can be a daunting task, but with the right knowledge and strategies, it can be a rewarding experience. Passive funds, also known as index funds, are designed to track the performance of a particular index, such as the S&P 500. These funds require minimal management, and their goal is to replicate the returns of the index they track. In contrast, active funds aim to outperform their benchmark index by making investment decisions based on market research and analysis. So, which one is better for maximizing profits? Let's dive in and find out. Passive funds. Passive funds are gaining popularity due to their low fees and high returns. According to a study by Morningstar, over the last 15 years, passive funds outperformed their active counterparts by an average of 0.45% per year. This may not seem like much, but over time, it can make a significant difference. One of the main advantages of passive funds is their low fees. Since they require minimal management, their expense ratios are lower than those of active funds. This means that more of your money goes towards your investment, and less goes towards fees. Additionally, passive funds offer diversified portfolios, which help to minimize risk. By investing in a broad range of stocks, you are less exposed to the risks associated with individual stocks. Now, let's take a look at some real-world examples of passive funds. Vanguard S&P 500 Index Fund thinks this fund tracks the performance of the S&P 500 Index, which includes the 500 largest publicly traded companies in the United States. Since its inception in 1976, it has provided an average annual return of 10.97%. iShares Core MSCI Total International Stock ETF, IXUS. This fund tracks the performance of the MSCI ACWI ex-USA Investable Market Index, which includes over 6,000 securities from developed and emerging markets. Since its inception in 2012, it has provided an average annual return of 5.87%. Active funds. Active funds are managed by professional fund managers who use research and analysis to make investment decisions. They aim to outperform their benchmark index by buying and selling stocks based on their analysis of the market. One advantage of active funds is the potential for higher returns. Skilled fund managers can identify undervalued stocks and capitalize on market trends, resulting in higher returns for investors. However, this potential for higher returns comes at a cost. Active funds have higher expense ratios, which means that investors pay more in fees. Let's take a look at some real-world examples of active funds. Fidelity Contra Fund, FCNTX. This fund is managed by William Danoff and has provided an average annual return of 14.35% since its inception in 1967. Danoff is known for his ability to identify undervalued stocks, resulting in significant returns for investors. T. Rowe Price Blue Chip Growth Fund, TRBCX. This fund is managed by Larry Puglia and has provided an average annual return of 15.14% since its inception in 1993. Puglia is known for his ability to identify growth stocks, resulting in higher returns for investors. Passive versus active funds, which one should you choose? Now that we have looked at the advantages and disadvantages of both passive and active funds, which one should you choose? The answer is not straightforward, as it depends on your investment goals, risk tolerance, and investment horizon. If you are a long-term investor with a low risk tolerance, passive funds may be the way to go. They offer diversification and low fees, which can result in steady, consistent returns over time. Additionally, passive funds are a good option for investors who do not have the time or expertise to research individual stocks. On the other hand, if you have a higher risk tolerance and are willing to pay higher fees for the potential of higher returns, active funds may be a better option. Active funds may also be a good choice for investors who want to invest in specific sectors or have a shorter investment horizon. It's important to note that while active funds have the potential for higher returns, they also carry higher risk. Fund managers may make poor investment decisions, resulting in lower returns for investors. Additionally, active funds may be subject to higher taxes due to their higher turnover rate. Ultimately, the decision between passive and active funds depends on your individual investment goals and risk tolerance. It's important to do your research, understand the fees and risks associated with each type of fund, and consult with a financial advisor if necessary. Conclusion. In summary, passive funds and active funds each have their advantages and disadvantages when it comes to maximizing profits in investing. Passive funds offer low fees and diversified portfolios, while active funds offer the potential for higher returns but come with higher fees and higher risk. When it comes to choosing between the two, it's important to consider your individual investment goals and risk tolerance. Both types of funds can be a valuable addition to a well-diversified investment portfolio, and it's important to do your research and consult with a financial advisor before making any investment decisions. Thank you for watching, and we hope this video has been informative and helpful. Don't forget to like and subscribe for more content like this.